Welcome, curious minds, to another deep dive. Our mission here is always the same. Cut through the noise, find those nuggets of knowledge, especially in financial trading.
Exactly. And today we're looking at a really interesting tool.
Yeah, today we're plunging into something powerful, maybe a bit less known. Donchian Channels.
That's right. You know, there are tons of indicators out there, but these Donchian channels, they offer a really unique way to look at the market.
How so?
Well, they help you grasp market dynamics, spot trends, and, this is crucial, manage risk really precisely. Maybe more so than some other tools.
Okay, so our deep dive today is all about unpacking these channels. We'll get into their pretty fascinating origins, right?
Definitely.
And then see how a seasoned trader like Suneil Kucchal, SK we'll call him, uses them now, for Forex.
We'll dig into the concepts behind them, how they link up with trends, swing structures.
And most importantly, how you can potentially use them. For that precise risk management, short-term trading, we'll look at that 13-hour trend specifically.
Yeah, and even touch on how other indicators can, confirm the signals. It's about building a picture.
All right, ready to dive in?
Absolutely. So to really get these channels, we need to rewind a bit. Back to the 1950s.
Okay.
And meet a real legend in commodities trading, Richard Donchian. He's the guy who invented them.
Richard Donchian. And his story is remarkable, you said.
It really is, because, most people back then, and maybe even now, think trading is just some kind of art. You're either born with it or you're not.
Right, an innate talent sort of thing.
Exactly. But Donchian, he completely challenged that idea. He was successful, sure, but he believed trading wasn't some mystery. He thought it could be systematized, taught.
Taught to anyone.
That was his belief, and he set out to prove it with this pretty famous experiment.
Okay, I'm intrigued. What kind of experiment?
He literally took a group of total beginners tradesmen, like carpenters, painters, people with zero trading background.
Wow.
And he set out to teach them how to trade successfully using a system he developed. And the core of that system, the Donchian Channels.
So the indicator came out of this need to teach novices systematically.
Pretty much. His original system was incredibly simple, really mechanical. You'd buy if the price broke above the highest high of the last 20 days.
Just like that. A simple rule.
Yep. And conversely, if it dropped below the lowest low of the last 20 days, you'd get out or maybe even go short.
No gut feelings, no reading the tea leaves, just rules.
Exactly. Purely mechanical, which back then really went against the grain,
And these trainees became quite famous, didn't they? The turtle traders.
That's them. The turtle traders. Their results were impressive, and it kind of sent shockwaves. It's solid proof that, maybe trading could be taught if you had a disciplined, systematic approach.
It's amazing how a concept from the 50s is still so relevant. So how does this basic idea translate to today's, much faster Forex markets? This brings us to SK's work.
Right. So SK, the author we're drawing from, he considers the Donchian channel, specifically the 13-hour Donchian channel, to be and this is his word, cornerstone of his scalping strategy.
Cornerstone. That's a strong word. But why 13 hours? That seems very specific. Not 10, not 20.
It does sound specific, doesn't it? SK explains it has links to the Fibonacci sequence and prime numbers. Concepts he explores earlier in his book, these sort of natural market rhythms.
Okay.
But the practical reason for scalping, he says, is that the 13-hour channel essentially captures every trend smaller than 13 hours.
So for those quick in and out trades, it keeps you aligned with the very immediate market pulse.
Precisely. You're right there with the short-term rhythm.
Which immediately makes me think about risk. Scalping feels like it needs really tight risk control.
You're absolutely right. And that's where SK says the 13-hour Donchian really shines. He calls it the best trend line to control our risk.
The best one. Okay.
And he makes a pretty bold claim that trading with it can safely generate 1% return on the account each time. Which, highlights how central it is to both his risk management and his profit goals.
A 1% return each time with safety. That's the dream for many traders, I imagine. What's the underlying market behavior that makes this 13-hour channel so good at finding these spots?
Okay, so to get that, we need to talk about price compression and expansion. It's fundamental market stuff.
Yeah.
SK uses this vivid analogy, stepping on a landmine. Imagine pressure building up. That's compression. The price gets squeezed.
Okay, like winding a spring.
Yeah, exactly. Then boom, it explodes. That's the expansion, the breakout. And this happens both ways. Pressure builds near support, price explodes up. Pressure builds near resistance, price breaks down.
The market releasing tension. Got it. And here's another analogy, the jackknife dive.
Yeah, the forward pike dive or jackknife. It's brilliant for visualizing turning points. Picture a diver jumping. At the very peak of their jump, they curl up tight, right? Position 3. In that moment, the distance head to toe that's like the Donchian Channel range is smallest.
Ah, the channel narrows.
Exactly. And their momentum, it's basically zero. They're suspended, just about to reverse direction and dive down.
So that curled up position on a chart, that's the sweet spot. Where a bigger trend, maybe like a daily 27-hour trend he mentions, is losing steam, narrowing its range, ready to turn.
That's precisely it. And that point often lines up with the 13-hour mark, which is roughly half of that 27-hour daily cycle. It represents the point of, theoretically, the least risk for a trade entry.
Because momentum is lowest, the range is tightest.
Right. It helps pinpoint those moments where the market might pivot with less initial force against you. That's why it's so key for risk management, in his view.
That paints a really clear picture. So thinking about trends and swings, SK says Donchian channels are actually superior to moving averages. Why?
It's a fair question. Moving averages smooth out closing prices, right? So they can lag behind what's actually happening. Donchian channels, though, they track the absolute highest high and lowest low over the period, the extremes.
So they capture the full volatility of the actual range.
Exactly. Not just an average. It gives you a clearer, more immediate boundary of price action. And this helps define market swings much more distinctly.
And how does the 13-hour structure specifically relate to those swings?
Well, SK connects a 13-hour breakout to something he calls a 3-bar swing on a 4-hour chart, the H4.
A 3-bar swing. What does that look like?
Think of it like this. Maybe a 6-hour trend up, then one distinct bar where it turns around a U-turn bar, and then a 6-hour trend down, like a mini peak.
Okay, a small cycle.
Right. And this little 3-bar pattern, he says it can give you advance notice of a 5-day trend reversal.
Wow, that early.
Yeah. The idea is if a bigger daily trend is going to turn, the 13-hour structure, that shorter-term pulse, will likely be the first thing to break. It's your early warning signal.
That's incredibly valuable. So based on that, I assume the advice is pretty clear. Don't fight that 13-hour trend.
Absolutely crystal clear. SK emphasizes, stay with the 13-3 trend and never trade against it, even for short-term scalping. It's fundamental. Keeps you flowing with the immediate momentum.
Right. Reduces getting chopped up by noise. Okay, let's get practical. How do traders actually use these breakouts for risk management and for that short-term scalping we talked about?
So the channels give you objective entry and exit points. Price breaks above the upper channel. That's a potential long entry signal.
Okay.
Price breaks below the lower channel. Potential short signal. Or maybe time to exit your long. Pretty straightforward.
But the risk management part is where the 13-hour channel really comes in.
That's the key. For a long trade, your stop loss goes right at the 13-hour Donchian low. For a short, it's right at the 13-hour Donchian high.
So it defines your risk very clearly from the outset.
Exactly. It gives the trend a bit of room, but your maximum potential loss is strictly defined by that recent low or high. Very disciplined.
And for scalping, that 13-hour breakout is the main opportunity generator, aiming for that 1%.
That's what SK suggests, yes. He sees that 13-hour breakout as the prime spot for scalping, often aiming to capture that 1% profit, potentially within, say, a 24-hour period.
And what about even faster charts, like 5-minute, 15-minute?
He mentions those too, but stresses that any scalping on those super short time frames must always respect the risk parameters set by the larger 2-day trading line.
Ah, so keeping the bigger picture in mind, even for tiny trades.
Right. It's about nested time frames, making sure your micro actions align with the controlled macro view, discipline across the board.
Makes sense. So Donchian channels are powerful, but SK is clear. One indicator isn't a whole system. You need confirmation, right?
Absolutely. That's a core part of his philosophy. A real trading system is a collection of tools working together, confirming each other.
Like an orchestra, as you said earlier.
Exactly.
Yeah.
And interestingly, he points out a direct link between Donchian channels and another popular system, Ichimoku.
Oh, really? How do they connect?
The midpoint of the Donchian channel range, halfway between the high and the low, is actually the same calculation as the Kijun-sen or Kei-sen line in Ichimoku.
No kidding. So they share DNA, essentially.
In a way, yes. It shows how these different tools can sometimes measure similar underlying market structures.
So how do other Ichimoku elements, like the cloud or the Chiku span, help confirm Donchian signals?
They add layers of context. The Chiku span, for example, plots the current price back in time. If it's clearly above past prices, it confirms upward momentum. The cloud itself shifts color and position, giving you a visual forecast of potential support and resistance zones and trend direction.
So Ichimoku provides a broader environmental check for the Donchian signal.
That's a good way to put it. It adds conviction.
And what about oscillators? Things like Williams-Purcell, where do they fit?
Oscillators are great for spotting short-term extremes within the main trend. They measure overbought or oversold conditions.
So not trend direction, but the ebbs and flows within the trend.
Precisely. They help identify potential dips in an uptrend to buy or rallies in a downtrend to sell short. SK mentions using Williams-Purcell with a 13 setting, tying it back to that key 13-hour time frame.
So you're timing your entry within the established 13-hour trend using the oscillator.
That's the idea. It helps refine the entry point.
So the big rule is confirmation is king. Never use one tool alone.
Absolutely. SK is very explicit. Never use the MAN CD in isolation, for example. Always pair an oscillator with a trend indicator, like Donchian. And critically, only trade in the direction the trend indicator is pointing.
Stick with the main flow.
Right. He also notes that something like the parabolic SAR often gives very similar signals to the Donchian channel, which acts as another layer of confirmation. It's about building a consensus among your tools.
Like building a case before you act.
Exactly like that.
Well, this has been a fascinating deep dive into Donchian channels. We started with Richard Donchian, the turtle traders.
Yeah.
Quite a story there.
Yeah, the origins are pretty cool.
And then saw how SK makes the 13-hour Donchian the absolute cornerstone of his Forex system.
Focusing on how it helps understand price compression, expansion, that whole jackknife dive analogy really helps visualize it.
It really does. And how it connects to trends, those 3-bar swings, giving early warnings.
And critically, how you use those breakouts for precise risk management with stop losses tied directly to the channel, and for those short-term scalping opportunities.
Always staying with that 13-hour trend.
And never forgetting confirmation. Integrating Ichimoku, using oscillators to refine entries within the trend. It's a whole system approach.
Definitely. So if you, the listener, want to really get deeper into this, see more examples, understand the nuances,
then checking out Suneil Kuchal's book, A Practical System for Trading Forex, is probably the next step. It lays out the whole system in detail.
Yeah, highly recommended if this sparked your interest.
And maybe leave you with this thought. The real skill in trading, perhaps, isn't just spotting a trend. It's mastering those precise turning points.
Finding that sweet spot.
Yeah, that moment of minimal risk, maximum potential, just like that diver hitting the perfect jackknife. Knowing when the market's coiled energy is about to release, that's the finesse.